Welcome back, everybody. Sive is here with the ForexPeaceArmy.com. Let's proceed with the analysis of the gold market. Actually, gold now stands, in fact, in the same situation as the euro currency. In fact, this is just two twins brothers. So setups, patterns, almost everything are equal here to the euro currency, except maybe one thing done on the daily chart. We do not have the bearish grabber on the gold. On the euro currency, we have the nominal bearish pattern, but on gold, we do not have it, although the overall shape of the price very similar to what we see on the euro actually as well. So what we're going to do and what we could do in the current circumstances. First of all, the major thing that you need to decide today is whether you would like to take the part in all this mess around the payrolls report as usual. If you decide to take part in it, then we could consider a few ways how you could do this. If you prefer to wait and see what will happen, that's also might be the decision. The reason for that is as follows. So if you take a look on the 4 time frame chart, in general, performance on the 4 time frame chart might be called as a bullish, because market has completed agreement resistance. A few days ago, we talked about the COP target. Recently, it has been reached. It's also 618 resistance, but you could see that market is not falling down. So retracement that we talked about has not started. Potential market could form here at the butterfly, for example, with the further upward continuation. We do not know. Maybe on the payrolls results, we particularly will get this drop if numbers will be more or less good. But currently, investors mostly expect bad numbers because of the ADP, because of the JOLT report. Chances to get big employment here are not really high. We will see. But as when every time where we're gambling around the numbers, any scenario is possible. But technically, currently it looks positive for a possible upward breakout. The same thing we could say on the hourly chart. So if you take a look carefully, you could see that market is forming triangle consolidation after completion of the COP target on the 4-hour time frame chart. Triangle is also potentially bullish sign. So taking it all together, if you would like to take the long position, mostly the same thing that I said today on the euro, you could think about using the stop entry order instead of the limit order, because once data will be released, if it will be weak or weaker than expected, market could start straightforward upward action. Then you could be filled right in the moment when the market will start breaking the top. So you could place your stop not above the top, because here will be big competition among the orders to get filled. It's better to place either right on the top level or slightly under it, very close to the top. And here you could get your fill, and you will be in the market. Also using stop buy order give you the partial protection in the case if markets start dropping immediately out of the triangle. For instance, data will be so strong that even no spikes will be formed to the upside, the market just start falling. That's also good to you because your stop buy order will be not filled at all, because market hasn't touched your fill level. That's the one thing that you could think about. If you still would like to use the classical approach in buying using limit orders, well, you could try, of course, to buy inside of the triangle, because we have a few times until payrolls will be reported. Just watch for the dynamic. Your task here is to buy as close to the lows as possible, just to minimize your potential risk. That's ways that you could actually use. Here's another option exists, that you could use double stop orders if you would like to trade on volatility, but that's puts you under risk of the possible double execution if volatility will be too strong. But in this case, you could place, for instance, 2 orders, stop buying one and stop selling, right? So you will be executed in one of the directions, except the situation where we get the big squeezes here in all directions with the big volatility. Sometimes it happens, not very often, but it might happen. So every way has its own advantages and disadvantages. Just decide what you like more, but based on a purely technical picture, it's not the prediction, it's just how market looks like. Here it shows more bullish signs rather than bearish in the current circumstances. It doesn't mean a lot, but well, at least it somehow will be handed to you for choosing the position direction. So that's probably all for now. Let's see what we get in the numbers. After that, it also will be important. CPI numbers report next day, so we will return back to the subject tomorrow. And let's see what will happen today in the evening.